You know, I have talked about in the past that the competition for closed-end funds isn't necessarily another investment strategy or some other kind of product structure. It's really lack of information. We've seen that in research where we've talked to financial advisors and they say, you know, I like it, but I don't feel I know enough about it. And of course, a financial advisor is not going to recommend something they're not comfortable explaining to their own clients. So I think that has remained fairly stable, that, you know, there's still this quest for more knowledge, a need for more understanding. That said, you know, as closed-end funds look more attractive to deliver regular cash flow or the potential for that, and we're still in an environment where people are looking for income, more and more are slowly finding their way to closed-end funds and, in fact, asking for the information so that they're smart and well prepared to help their clients. Now, I'm asked a lot about what do rising rates mean for closed-end funds, and you kind of have to parse it a little bit. Many closed-end funds invest in bond portfolios, and of course a long bond portfolio in a rising rate environment is probably going to suffer some decline in actual value as the bonds need to revalue to keep up with the higher rates. However, it's a little more complicated when you have a leveraged closed-end fund. That portfolio was probably put together for the income, not the actual net asset value, the income potential. And that's going to remain largely the same from the underlying bonds, unless as they get called out and actively managed through there. When leverage is used, however, then the fund is borrowing at short rates, and those are the ones that are changing more rapidly right now. So that's compressing the income, the additional income that's coming from leverage. The bonds themselves aren't really necessarily changing, but the additional income from leverage is getting compressed. So leverage tends to work less well. You've seen some, especially long municipal bond funds, cut their distribution somewhat to accommodate the fact that leverage costs have gone up. So it doesn't mean that you should sell every closed-end fund in a rising rate environment. You do need to understand, well, what's the effect of leverage? Is my spread between borrowing costs and investment coupons changing? That's going to affect then the income. So leverage right now is largely floating rate leverage, so it's changing with prevailing short-term market rates. So as prevailing short-term market rates have risen with Fed rate changes and other dynamics, the cost of leverage has risen over the last year and a half, whether that's on the taxable side or the tax-free side. And that does affect a fund's ability to generate income. If your portfolio is generating bond income that's fairly stable, but your borrowing costs are rising, yeah, your additional income from leverage is going to be shrinking a little bit, and that may affect the ability to make distributions for a fund. So cuts have been seen, and I would expect some in the future. That said, leverage is still probably going to work, and the closed-end fund for the long-term patient shareholder probably is going to be a very good income vehicle, at least for the long-term person who understands what they're in for. I have been asked about fund mergers. Some people think they're this plot, and in fact, it's really almost all goodness for the shareholder. Number one, you get a bigger fund. So trading on the exchange, there's much more liquidity. More people can buy and sell. You don't have to sit there and trade by appointment. Pricing becomes closer to net asset value over in general. Everything is relative there. So trading liquidity improves. A bigger fund gets more coverage from analysts. That's usually good for the shareholder. And many funds have expense ratios that diminish as the fund gets bigger, so you get kind of a volume discount. That's also better. And then finally, on the portfolio manager level, the portfolio manager has more assets to manage and probably has more flexibility to pursue the strategy in the way he or she seems fit. So overall, fund mergers have been a very good thing for shareholders, I believe. You know, advisors who are new to closed-end funds, number one, should remember this is not an asset class. it's a structure. And that structure, because you have a closed portfolio, has certain features and benefits, as well as things to consider and that might not be such happy good news. Number one, the structure is fairly stable, so the portfolios can invest in things that are less liquid as well as things that are more liquid. Number two, the opportunity for leverage. Leverage is going to multiply. So an advisor or investor looking at that, so if the markets go up, you've multiplied, that's good. If markets go down, you've multiplied, that's not so good. So that volatility. So number one, it's a structure. Number two, volatility occurs. Number three, volatility also occurs because of exchange listings. So you want to be careful trading closed-end funds. There are a lot of resources, whether that's CEFA.com, CEF Connect, a fund company itself, or the firm that the financial advisor works for may have additional resources. So I'd say number one, it's a structure, not an asset class. Number two, fair amount of volatility, but some of that volatility and the structure create benefits.